Hello, welcome back to Unicorn Investing. And today I want to talk to you about the kind of growth companies that we should be investing in. And to illustrate that, I want to use the business life cycle chart to make it easier for us to identify, recognize the kind of companies, the kind of businesses that are growing, and we want to invest in them while they are either starting to grow or growing at an exponential phase. What we want to avoid are businesses, obviously, we want to avoid those on the decline. And I just want to give a very simple example, like, for example, due to the creation of the smartphone by Apple, you see businesses like Nokia, Kodak, big time, they got disrupted big time and they vanished. So we want to be able to see early, we want to be able to see far into the future. Well, it doesn't have to be very far, but at least 1 or 2 years ahead of time. And we will be able to see that certain major disruptive trends are disrupting certain businesses. So we want to avoid investing in this kind of companies. And a lot of times you find that what value investors call value buys, because it's cheap, it is a good buy, they are actually already on the decline. So we want to avoid those. But today I want to talk about the 5 different types of growth companies, right? Be able to distinguish them and focus on building a portfolio by focusing on the right kind of growth businesses. Right. So if we look at the business life cycle, there is the introduction stage, the growth stage, as well as the maturity stage. The introduction stage, I would say, describe 2 kinds of growth stocks. One, you have the hype growth. That means these are the companies with a grand story. It's like a mega. It's like it's a huge growth story. Sometimes it's just a dream, right? It's just a story. The founders know how to tell very nice story, but they eventually fizzle out because they do not follow up with solid growth in both revenues as well as profits. So these are the so-called hype growth stocks. And I'll give you 2 examples of each of these later on. And then we have the rising stars. These are the early stage growth businesses. They are really growing and they have solid revenue growth, but they are not yet in profitable stage yet. And then there are the next kind of growth companies are what I call solid growth. By solid growth, meaning they are already growing very quickly, maybe most of the time more than 20% per annum, like 30, 40%, up to 50 or even more per year, per annum, right? Every year they're growing 20, 30, 40% or more, right? Solid growth, and also at the same time enjoying healthy profit margins. And out of this group of solid growth stocks, there could be a very few stocks which I call the new fangs, because you find that the fangs are the fangs are Facebook, Amazon, Apple, Netflix, and Google, right? These are the companies that have changed the world in the last 10 years, right? Especially in the last 10 years, but they actually started disrupting the world more than 10 years ago. But in the last 10 years, they really took off, and a lot of them become powerful revenue and profit generators. And each of these FANG disrupt a major sector of the world. Like, for example, Facebook introduced social media, and disrupted the entire media world. Then you have Apple, which disrupted the telecommunications, introduced the smartphones. Then you have Amazon, right, which brought in the era of e-commerce and disrupted how retail is done. And then you have Netflix. Again, it disrupts entertainment. It disrupts the entertainment circle. And finally, you have Google, disrupted the media world and disrupted how the world is ordered because of, so how, I think we all know how all these different FANG stocks disrupted the business world as well as the world at large. So new FANG, in my perspective, I'm referring to the kind of new solid growth businesses that is going to disrupt the world in the same similar, or if not larger magnitude, similar to the FANG stocks. And then, of course, finally, you have the mature growth. And I think that these FANG stocks, they are already in the mature growth because, like, for example, Microsoft, I would actually like to include Microsoft in the FANG, although Microsoft was of an earlier generation of disruptive businesses, you know. So these are companies that, like, for example, when the PC was first introduced in the world, Microsoft mission, or rather Bill Gates' vision and mission is to put a computer, a PC into every desk, on every desk. And has that mission been achieved already? Yes, it has been achieved. It has been fulfilled. So basically, mature growth are businesses that have already realized their vision and mission. Like, for example, the FANG stocks, right? Yeah, has Facebook conquered the world of social media, or introduced the world of social media and conquered the world of social media? I think they have pretty much done that. All right. And likewise for Apple, for Amazon, for Netflix, and as well as Google. And that's why I call them the mature growth, right? And new FANG refer to new businesses that are about to do what the FANG stocks have done in the last 10 years. So one question to ask yourself now is, if you are to develop a portfolio of stocks, what kind of businesses would you like to invest in? Would you like to put your money in the mature growth businesses? Or would you like to look for a new FANG and put your money there? Or solid growth, rising stars, anybody for hype growth kind of stocks? All right, so let me show you some charts now. And I'm going to do some comparison on their price volatility. Okay, so I'm going to do a comparison for all these different growth stocks of their price volatility, of their revenue and net income growth. Net income meaning net profit growth, right? So I'm going to compare their price volatility and net income growth. Net revenue, I mean either revenue or net income growth. Then you will decide for yourself what kind of growth companies you like to invest in, because at different stages, the price volatility of these businesses are different. They have different volatility characteristics. And I'm using very simple revenue and net profit metrics. That is a very simple way to recognize them. All right. Of course, there are some other metrics which I will discuss with you in the next few videos. But today we're just doing very simple comparison so that we can recognize the differences of these different growth companies. All right, let's do that. So in this, so I have identified 5 different, or rather 8 different stocks here. And I will start with the the mature growth businesses first, right? First, we have Microsoft, right? This is the daily chart of Microsoft, going all the way back to before 2016, right? In fact, as we know, Microsoft have been around for a long, long time. So imagine if you started investing in Microsoft 10 years ago. Can you imagine how much your investment have grown from $31 all the way to right now it is $308. So it's like tenfold, 10 times. So imagine, like I say, you just own a stock and you just hold the stock for a long period of time, what is going to happen to investment. But we want to check out the price volatility just for over maybe the last couple of years. But as you can see, the Microsoft share price doesn't go up in a straight line. In fact, it is good because it is good that it is not in a straight line, because then it gives us opportunity to profit from investing in the stock. Now, so as you can see here, due to the COVID-19 pandemic that hit the stock market in February, Microsoft actually plunged by about almost 30%. All right, and this 30% happened in just like 1 month, or 1 to 2 months, plunge all the way. But it has soon recovered well above the pre-pandemic price level and has gone on to, to now is $308. So even the best of growth companies like Microsoft suffer price volatility like this, okay? It is up to 30%. So that's why I mentioned we have to be prepared for occasional, these once in a blue moon occasional corrections. If we can hold, then we can win, we can profit. But there are also other strategies that we can make better returns, perform better with some strategies to take advantage of these corrections or so-called stock market crashes. So this is Microsoft. Worst was in our recent history, the worst pullback is 30%. All right, so let's look at some other stocks. All right, we have Apple here, another one of those FANG stocks, and we can see a major pullback here. Again, this happened in the same period of time, the pandemic, and here we can see a pullback of 34%. Wow, 34%, even more. And there are also some major pullbacks here. So even huge companies, Apple has the largest market cap in the world. Even huge market cap businesses like Apple suffer a lot of price volatility. I think for a lot of people, 20 over to 30 over % of corrections is considered huge. But yet, if you really look at the long run over the years, Apple has multiplied many times. Like if you hold it for 10 years, all right, from 200, from here you have 2011, let's say, is about $11. Now is all right, it's 148. So it's also more than 10 times. So these are the two, what I call mature growth businesses, right, that we can invest in. The next, I like to talk about what I consider a new FANG, all right, the new FANG. Why I say the new FANG? Because we have, the media has been disrupted, the mobile phones have been disrupted, telecommunications have been disrupted, media, entertainment has been disrupted, and so on and so forth. So why not the automobile industry? As I think a lot of people can see, electric vehicles, is disrupting the automobile industry, and it's going to have a greater, it has a huge disruptor, it's going to be a huge disruption. Can you imagine smartphone or the PC is how much they're selling for? $1,000 over $2,000 right? But a mobile, an electric vehicle or an automobile is in the, like it can be 50, 100,000, a few $100,000 worth. So there's a huge industry. And Tesla is the market leader of this up and coming sector. And currently, electric vehicles is only representing about 3%, 2 to 3% of new automobile sales in the world right now. So there's a long growth path to go. And as we look at Tesla, you can also see that it keeps breaking new highs. And it is also a very volatile stock. And I would think that a new FANG stock like this, in my opinion, all right, you can see here 40% crash, 40% correction. So that's the kind of price volatility. Actually, not that bad. It's not that bad, because even if you look at the fact, just now I showed you Apple stock, it also went down by more than 30, down by 30%, right? In its recent history correction. So Tesla is not too bad, and it's now recovering, and I foresee it to break new high very soon. The next new FANG that I like to talk about, well, I'm not sure whether it is a new FANG, but I'm sure it is a solid growth business, right? If we look at the earlier business life cycle here, I have the solid growth as well as the new FANG. So the new FANG has to come from the solid growth businesses. So here I have one example of, in my opinion, what I consider solid growth, and that is Shopify. As you can also see the price volatility, there's a lot of volatility here, and I can see one very big one here. And let's measure the price volatility here. It is 31%, right? So as we can see that in a major correction, 30% is quite normal, even for solid growth businesses like Microsoft, Apple, Tesla, Shopify. And the next, we're going to look at Spotify, which I consider a rising star. Later, I'll explain to you why I categorize them this way. So let's look at a rising star. I have two examples of rising stars, Spotify, all right? And can you see the difference here, right? So Spotify haven't, so this is an intraday high here, and its lowest point is almost 50%, almost 48%, all right, coming to 50%. So if you invest in a rising star business like Spotify, you have to be ready for this kind of pullback, because in case, right, if in case you bought at the wrong time, you bought here right at the top, then, and you were still holding now, right, is already down by 50%. So not many people can stomach this kind of correction, but I'm confident that the best days are still ahead of Spotify, and we're going to see sometime in the near future that Spotify is going to break new high, and it's going to go higher, just as it has done before, right? It has done that. Even like you can see here, there's quite a long period of correction. Yeah. This long period of correction, where the correction was also another almost come to 50%, and it lasted for more than 2 years, coming to 2 years before it broke higher. So there are reasons why growth businesses go through this kind of corrections. I have not released. I I'm not talking about, sorry, I'm not referring you to, I'm not able to refer you to the story behind as to why Spotify corrected almost 50% over a period of 2 years. But from my first hunch is that because most of the time for new businesses, their earnings, their revenues is not stable. Sometimes up and down, sometimes, sometimes like sounds very promising, sometimes like very bad. So, so investors tend to get very reactive towards all these kind of uncertainties. And that's why sometimes investors are very optimistic and then sometimes they are super pessimistic. So that's why due to all these kind of reactions, very sentimental reactions, that's why you see the stock price fluctuate so wildly, right? Suddenly so bullish, suddenly becomes so bearish, So that is so we can see here that rising stars are more volatile than solid growth and mature growth businesses. One more example of rising star business, Palantir. I think so far most of you may have heard of those examples that are given you, including the last one, which is Spotify. I'm using Spotify personally. I think a lot of you may be using Spotify also, but maybe not too many people know of Palantir. So Palantir is a big data analysis software solution business. And from its high of intraday high, we see a crash of 61%, right? So now it has recovered. So now it is still down from the high, still 45% down from the high. So you see, when we invest in growth stocks, especially when you are not making profits, right, there will be wild fluctuations to the price. Okay, so let me stop here for a while. So I've just shown you the price charts for some of these businesses, but let me show you a simple way of defining what is, in my opinion, hype growth. We're not going to talk about hype growth, right? Because it is hype, all right? If it is hype, if you like the story, you just buy a stock based on story, then you buy into a hype growth stock. But if the business is really promising and has a good growth trajectory, then we are buying into rising stars, buying into solid growth, and buying into the FANG of tomorrow. So I want to start off by showing you some information about Microsoft. So we have here Microsoft. As you can see here, if we look at Microsoft total revenue, right, for over the last 3 years, you don't have to look too far. You can see this chart, this line, this revenue line is going up, all right? Going up means it's growing up. So the only question is how fast it is growing. The curve is not very steep, but it is growing, all right? So that's how I consider this as mature growth, right? It is growing, but not very fast because it has already gone past its fastest growth years. If we look at the maximum, look at like all the way, like from 1991, you can see here how, initially it is growing slowly, and then after that you can see it's growing faster. Actually, now it is still growing fast. In fact, because these mega caps, they are very powerful, very innovative, and they keep innovating and introducing new solutions. So actually, in Microsoft history, you can see that actually the growth has not really slowed down yet. It is still growing fast, right? So it is a good buy, in my opinion. And there is also the net income, right? wow, there is an acceleration of net income. Can you see? The curve has steepened here, right? So Microsoft is becoming more and more profitable. So these are mature growth companies, but looking at this curve, maybe I wouldn't say it's mature because it doesn't look like it's going to go into decline anytime soon, probably not in the next 5 to 10 years. There's still a very good growth path for a business like Microsoft. So next, we're going to look at Apple. Okay, so Apple, which I showed you on the chart earlier. So the same thing, I'm going to look at Apple's total revenue. And Apple has been around for a long time. So let's look at the 10 years. Well, you can also see an acceleration of Apple revenue here. Okay, so this Apple has been growing for the last 10 years, but I seem to see an acceleration here, especially since the COVID pandemic. So a lot of these FANG businesses, their growth is actually accelerating because of the pandemic. And in terms of net profit, net income, wow, an acceleration here. Okay, there is an acceleration here. So do you foresee Apple's net income continue to accelerate? Because if it does, then this price chart, we may soon see Apple break new highs again because the price have been ranging on the upward, okay, slightly on the upwards direction. But if Apple net income continue to accelerate like this, I think it won't be long before it break new high. So the next stock we're going to look at is Tesla. Again, we're going to look at the revenue and income, and the revenue let's look at the last 3 years because we know that Tesla only started growing exponentially in the last 1 or 2 years. And so indeed, we can see this steepening of the revenue curve, which is growing. Now the annual growth is annual revenue is exceeding 40 billion. That's a lot. And let's look at the net income. Net income, which is net profit, is also accelerating. Okay, especially we can see here it crossed the zero mark here. It crossed, and now it is more than $2 billion in terms of trailing 12 months net income. So now we are seeing solid growth, solid profits, solid revenue, as well as solid net profit growth. And let's look at Shopify. So Shopify revenue last 3 years, accelerated. You can see how fast it is growing, right? Wow. You see again, the pandemic has really steepened Shopify's revenue growth curve. What about the net profit? Wow, you can see it really spike up in the year 2000, and now we are in 2001. So that's why I call it solid growth. Okay, next, let's look at Spotify. Let's look at Spotify total revenue chart. Okay, to qualify as a growth company, the revenue curve must be growing, all right? The revenue curve must be growing. The steeper the growth curve, the growth chart, the better it is, because it shows that it is growing faster, right? So for Spotify, not bad, right? But this looks like at least 20% per annum growth, okay, for Spotify. And what about net income? You see net income, it is still minus, it is below 2. It is right now. And you can see that the net profit is a bit unstable. Sometimes got profit, most times no profit. And right now it is still making losses every quarter. So that's why I classify it as a rising star, not as solid growth. Because solid growth, in order for me to see a high quality growth stock, I would like to see not only revenue growth, but also profit growth. So Spotify, you can see solid revenue growth, but not yet in profit growth, not yet profit. Okay, and the last one, PLTR, Palantir, again, why I classify it as a rising star? Because yes, we have revenue growth, not a long pathway, because Palantir is only listed not very long ago. But it is certainly growing, and I know it is, and not bad. It's very respectable revenues, already exceeded 1.2 B. But when we look at the income growth, the net income, you can see it is not yet making money. In fact, it is losing more money. You know, in the last few quarters, it is actually losing more money. You see? It's losing more and more. Now it's losing more than $1 billion a year. So back to our price charts. I have classified these two as mature growth, right? I will still consider them mature growth because they have already kind of like realized their vision and mission. And now they still have to keep on innovating to make sure that they continue to grow their revenue and profits. These are cash cows. These are cash cows. And these are solid growth businesses, Tesla, Shopify. There are many others, but right here, I'm only giving 2 examples of each category. And also we have the rising stars. They are called rising stars to me because they have fast growth, but not yet showing profits, right? And then here, these two are what I call the hype growth. These are the ones that you should avoid, right? That's why if you, and these are the companies that have poor revenue and poor revenues and poor profits. But, you know, you may be tempted to buy into them, right? Because they are very, you know, they are fueled by stories and dreams and, you know, so it's yeah, it kind of like pull in a lot of people into it, and so we have to avoid buying into this kind of companies, because if you get sucked into it, it's like a pump and dump kind of stock. You know, you get sucked into it, then you may never recover, because I have no idea this kind of company whether, you know, may just die. You know, yeah, these are the kind of company that may just go bust. Nikola. Yeah, Nikola is the story that promised a new era of electric vehicles that run on hydrogen fuel, right? For Virgin Galactic space, I'm actually quite reluctant to categorize Virgin Galactic into the hype growth, but the main reason, first of all, is that they hardly have any revenues and definitely no profits, and they're burning profit, and their competitors are too strong for them. You know, first and foremost, you have SpaceX, which is Elon Musk company, SpaceX, which is the leader of this sector, and then you also have Blue Origin. So I'm really not so sure where will Virgin Galactic be in the next couple of years. And as you can see here, you know, I bought into space, you know, at a certain time, but I quickly sold it because I just want to get involved in this kind of hype growth companies, you know. So, well, I hope you have learned something today. Generally, in terms of portfolio size allocation, I think it is all right if, you know, if you put in a bigger weightage of your portfolio into companies like these here, these 4. So maybe I would say that I would like to I think for a healthy portfolio, it is probably wise to put in about up to 50% of your portfolio into the mature growth as well as the solid growth businesses, and then maybe even 70%. All right, 70% of all your funds into this kind of companies, the mature growth as well as solid growth companies, because they are really solid and they keep on breaking new highs and they will recover from whatever corrections, whatever price corrections. And maybe only up to 25% in the rising stars, right? So, but among the rising stars, I would like to have a bigger collection. So I wouldn't just, invest 25% of my portfolio into 2 rising stars. I would need to have probably 10 to 15 or even 20 rising stars. Maybe that's a bit too much, but at least 10, all right? So if I have 100,000 and I want to have 25% into rising stars, then I will make sure that the $25,000 is split into 10 different companies. So which means that each company, I will only invest $2,500 to be safe, right? And then I don't mind having 70 to 75% of my portfolio into the mature growth as well as solid growth companies. But for my risk profile, I would like to have more weighted towards the solid growth or the new FANG. Okay, so I would give 50% of my portfolio to the likes of Tesla and Shopify and some others, which I consider under solid growth, and then 25% in the mature growth businesses. So I think that would be a healthy portfolio in terms of position sizing. I know I did suggest the investing rule of distributing your funds evenly across a basket of stocks, but in this video, I'm sharing deeper into how we can manage our portfolio in terms of our confidence in the kind of companies that we are investing to, so we can allocate more funds to growth businesses that have more solid revenue and solid profit growth, and we can allocate a smaller percentage of our portfolio size into the rising stars, which have a good growth trajectory but not seeing profits yet. So I hope you have some good takeaways from today's sharing, and let me know if you have any questions, and I look forward to talking to you again. Thank you.